Hey guys, today I want to talk all about leasing a car, what goes into it. Let's break it down, let's break down the math, and let's see how that actually stacks up, okay? But if it's your first time joining us, my name is Michael Foley. I'm a certified financial planner and student loan professional, and I'm also the son of two doctors and really designed lifestyle creep to help take care of those who are taking care of us and really help our healthcare workers in our society be more intentional in their finances and help them make more wise financial decisions and be more humble and quiet in their own finances. So let's dive in today. So the common question that we always get is how should we be thinking about a car purchase, and should I buy, should I lease, and what should go into that? But I think a lot of the times the buying a car is a little bit more straightforward of an understanding of, okay, hey, we put this much money down, we finance the rest, or we just buy it all outright. A little bit more straightforward, right? But I think the lease payment confuses people sometimes. And so I want to break down the math so you actually can see how do they generate that lease payment and what does it actually mean and what are some considerations with that, okay? So before we dive into any of this, I want to help you understand depreciation on a car. So unfortunately, cars depreciate in value. So that means that the worth of the car goes down over time. And so I encourage you to look at the depreciation curve, which is something that I've drawn out here. Some cars depreciate much faster than other cars. And so there's great resources online to explore maybe the car that you're looking at, how fast does it depreciate? And, different sites called like Car Edge or maybe Edmunds, some of these other sites, they offer some great assessments of, what are we expecting from a depreciation on your vehicle. So sometimes when we can kind of identify how fast that car is going to depreciate is going to be helpful. But when we're calculating a lease payment, that depreciation curve is really important, right? So if let's say we bought the car for $50,000 is what the car we're looking at, right? So what they're going to do is they're going to identify, all right, what does the manufacturer think that car is going to be worth at the end of the lease term? So let's say a 36-month term, very common lease term, 3 years. After 3 years, and maybe you're putting 10,000 miles on it each year, what do we think the value of that car is going to be? And so that value that they identify is considered your residual value. So in this example, let's say we bought the car for 50,000. They think that after 3 years and 10,000 miles or 12,000 miles, they think that it's going to be worth, after 3 years, maybe $30,000. Okay, so now we have $20,000 that has been the car's worth has depreciated during that time. Okay, so when they're determining what the lease payment is, the best way to think of it is you're paying just the depreciation on the car instead of financing the whole thing and paying for the whole thing and then having something at the end that you were to sell. If you were own the car, the leasing, you actually you're never really owning the car. You're essentially just renting it, and they're charging you what the loss of the car is going to be during the time that you're renting it from them. Okay, so it's not that easy, but if it was, it would be very straightforward. However, there's a couple other things that go into that lease payment. Okay, so in that lease payment, we have the depreciation that we just talked about. So they essentially take that $20,000, they divide it by maybe 36 months, and that's our depreciation. So depreciation monthly, and then they times it by this thing called the money factor. So you still got to think about it. You're taking over the use of this car for the entire time, and so they're actually charging you interest on the use of that car. So it's as if you purchase the whole car essentially, but instead of having to make principal and interest payments, it's as if you're just making interest payments on that. Okay, so maybe an oversimplification, but essentially what's happening is they determine what is called a money factor. And so you can always ask the dealer, what is the money factor on a lease for this vehicle that we're looking at? And that money factor is going to be some crazy decimal point. And so, but if you take that crazy decimal point and multiply it by 2,400, that's going to get you what is the interest rate that they're charging you on that interest that goes into your lease payment. Because a lot of people think, oh, I'm going to lease, I don't want to finance, rates are really bad. Well, either way, you're going to have to finance some money in there. And so it's good to know what is that interest rate that is factored into your lease payment, because that's going to help you in determining buying versus leasing as well. Okay. So we take the depreciation, build it, looking at that monthly, times it by that money factor that they're talking about, essentially the interest rate, or they call it the finance fee sometimes. And then you got to add in taxes. So any sort of sales tax in whatever county that you're buying the car in, whatever city you're buying the car in, you got to pay sales tax on that. Okay. That is, so we take the depreciation times money factor times taxes, and that gets your monthly payment amount. Okay, so it's just helpful to understand what actually goes into the math on this, because when we look at that and comparing that to purchasing a car, there's some different things that we're going to want to be thinking through. But understanding that sometimes maybe if your situation is maybe right now you bought a car during COVID and you're tremendously underwater in your car, meaning that you owe more to the bank than the car is worth, unfortunately. That's something that sometimes rolling that negative into a lease payment can sometimes be helpful for you. It's a little bit of a hack, because what it allows you to do is, yes, you get to, you still have to pay that extra, let's say you're down $10,000, you owe $10,000 more than the car's worth. Well, they're essentially just going to take this and just add $10,000 to it, but you get to finance it at that money factor and kind of bite the bullet on a higher payment maybe during that time that you're leasing the car. But then at the end of the lease, you're done. You're not necessarily refinancing that negative over another maybe 60 or 72 month period if you were to finance a new car. So something to think about. And then heaven forbid, if you were to total that car, if you have what's called gap insurance during that, then it's taken care of, right? So it's a great opportunity if we're coming into needing a new car, but we owe more than the car is worth. The leasing could be a great opportunity. Okay. Another opportunity is for business owners. So sometimes if you're a business owner, writing off your car is quite the beast. There's lots of different ways you can write off a car as a business owner. Leasing is probably the easiest and the cleanest, because you just have that one monthly payment. And so whatever percentage of use that you have on the car, you can work with your CPA or accountant and determine what is an appropriate amount. You have to keep mileage logs and things like that. There's a lot more. So taxes are not my lane. Talk to the CPA on that. However, it's a lot cleaner when we have just a lease payment that we can write off a percentage of, as opposed to having to try, do all these other things with depreciation for the actual ownership of the vehicle. So both are possible, but typically it is a little bit easier as a business owner to write off a lease payment if that is something that you're using a vehicle for work. Okay. Now, one thing that I wanted to make sure that people are thinking of, if you're currently leasing a car, it's really important to identify, use some of those resources like Car Edge or some of these other sites to identify what is the value of your car. So a lot of people are taking a look at this and they say, all right, well, I'm coming up on the end of my lease, I'm just going to turn my car back in. Well, let's check the math on the manufacturer. Did they actually do well? Because this was a guess. This residual value is frankly a guess of what they're thinking that the car is going to be worth. But maybe you didn't put as many miles on it, or maybe the market is just really hot right now, and maybe your car is actually worth more than the residual value. Because if that is the case, at the end, there's always going to be a buyout option. So you can say, hey, they're going to give you a residual value that you can buy this car out for at the end of your lease. So if you say, hey, I'm done with this, I want to buy it at $30,000, but what if the car's worth $35,000? What if it didn't actually depreciate all the way to the $30,000? Now it's worth $35,000. Well, now you could cut a check and pay the $30,000 to them, and you're buying a $35,000 car. So now we have $5,000 of money that we could be making if we turn around and sell that same car. So don't be so fast to just turn the lease right back in, because there might be some equity that you have in that. And then on the other side of it, there's a lot of questions with the electric cars, and sometimes we don't even have the data for what we are expecting the depreciation to be. It makes me nervous when I'm looking at some of these electric cars. They're great right now. Some of them are holding their value, but I don't know really. There's kind of uncharted territory, and so if I'm going into buying maybe an electric car, this is maybe a little bit less risky in a situation like that, because if they're projecting the residual value at, maybe by electric car 50,000, they're projecting in 3 years that the car's worth $30,000. Well, great. They'd have to take that car back regardless of if it's worth $30,000 or if it's worth $10,000. You just have to turn that car back in. But if you own that car and then, now you bought it at $50,000 and at the 3-year mark it's worth $10,000, we actually did lose all of that money, right? And so it's important to be thoughtful about when we're looking at leases, whether we're looking at acquiring a new car and considering buying versus leasing, or we're looking at turning back in a lease. Hopefully this is helpful to understand kind of the ins and outs of the lease and where you can maybe take advantage of this as an opportunity. But, as a general rule, leasing is more of a luxury, right? Obviously the less debt that we can have and the less monthly payments we can have in your finances is going to make life a lot easier, and we're not going to be kind of a continued slave to the lenders, right? However, sometimes we need a car, and this could be a great way to not jeopardize other areas of our finances to get into a situation that we might need. So don't rule the lease out entirely. However, there are strong arguments on other reasons that we might want to own the car that we can talk about in future episodes. So stay tuned, and we'll see you in the next episode. Thanks so much. Bye-bye.